Hello traders, Rich here, and here's a quick but detailed update on GBPCHF. As usual, if you like video analysis, let me know in the comments or simply leave a like. So let's get started. As we clearly see, GBPCHF has been stuck inside this range for a while in the shape of a descending triangle, which is a bearish pattern because it shows that we are in a range. However, the bears are clearly pushing, resulting in lower highs. However, they are not in full control yet because we've got equal lows. For the bears to take over from a long-term perspective, we need to see a break below the zone, and by break, I mean a daily candle close and not just a wick, just like this one. Meanwhile, until the bears take over to look for a sell on the retest, we are still above the zone, so we'll be looking for buy setups. If you zoom into H1 time frame, you can see that this previous bearish movement is engulfed by this channel. So for the bulls to take over and to reject this lower bound, we'll be waiting for the break above the zone, and we are forming like an inverse head and shoulders pattern. If we have a candle close above the zone, we'll go for a long position and we'll target a 1 to 2 risk to reward ratio as usual to have an edge over the market from a risk management perspective. Of course, meanwhile, we can still trade lower and lower and even break it down from daily. In this case, we'll be looking for sell setups on the retest. Before we continue, I want to tell you about Tickmill. Tickmill is established in 2014 and is one of the leading Forex and CFD brokers with registered users from more than 200 different countries. Tickmill is a no-dealing desk and ECN broker regulated in many countries like the UK, Cyprus, and recently in South Africa. With Tickmill, you can trade a wide range of instruments, starting from Forex to indices, commodities, and even crypto. Most importantly, with very low spreads and trading fees. If you don't have an account yet, make sure to create one using my referral link in the description below to benefit from 5% discounts on your trading fees. And let's continue. If you remember from my last picture analysis, we were waiting for price to reach around this area to look for buy setups because it was the intersection of the demand zone, previous resistance turned support, also the lower trend line here acting as a non-horizontal support. Anyway, the price rejected the zone and we traded higher, but we are overall bearish, so this is a correction bullish movement as you clearly see. So impulse, correction, impulse, and this is a correction. That's why as we approach this upper bound of this falling channel, we'll be looking for trend following sell setups. If you zoom into H4 time frame, you can see that this correction is engulfed by this channel and the upper bound of it is lining up upper orange trend line, adding more confluence or strength to our analysis. If we zoom into H1 time frame, you can see that this latest movement is engulfed by this rising broadening wedge. So for the bear to take over, we need to see a break below the trend line and the previous major swing low, which might be this area. Of course, when the sell is activated, the stop loss will be above the previous swing high and we target a 1 to 2 risk to reward ratio to have an edge over the market from a risk management perspective. Of course, meanwhile, until the bears take over and that the cat can still trade higher, form new lows, and then break it downward. But as long as we are around this area, we are looking for the setups, but waiting for the bears to take over before we shoot. Best of luck, and I'll see you hopefully on the next one.